Merry Christmas to the short sellers because, oh my gosh, the market is selling off again on some old data. And we're going to talk about that old data in this video, and it's quite remarkable. But it's, you know what? Just not nearly as remarkable as this thing called the put-call ratio, which is absolutely insane and, in my opinion, setting up for a little squeezy-deezies. Take a look at this. This is the put-call ratio, which basically asks, okay, how many put contracts or short contracts are there in the market versus how many call contracts are there? Well, you take the numbers and you divide them. So for example, if there are 150 puts, 100 calls, put-call ratio is 1.5. Simple math. Need a further explanation? Rewind. Now, well, that I should say, that ratio is usually bullishly directed, right? It's usually sitting at a number under 1, which means you have actually more calls than you have puts. Even in March of 2020, we sat at a put-call ratio of like 0.86. Over here at the end of 2018, we sat at like 1.13. Folks, now we are sitting at 2.03. And the only chart that I could get to go all the way back in time goes back to 2004, is at least the oldest chart I got, which is a little annoying because I'm like, I want to see the dot-com bubble. But anyway, this is the best we're going to have for now. Look at this. Even going through, at the very least, the great financial crisis, we don't have as many puts outstanding then as we do now. Folks, I would not be shocked whatsoever if we are sitting, or setting up, I should say, for one of the greatest short squeezes in history, ever. I personally believe, this is just my opinion, that the only way you can make money right now is by shorting. At least that's what it feels like, right? And I think retail realizes this. But because of the ease of trading that we have today, relative to how complicated it was to do options back during the great financial crisis, I think everybody, their mommy, their daddy, their granddaddy, and their 7-year-old son are going on Robinhood going, short, oh, I'm making money. I like this game. But when that squeeze comes, the covering, I think is going to be glorious. Now, that's, of course, Mr. Bias to the upside. Meet Kevin, flip-flop, or doody-leedy. Next thing you know, tomorrow I'll be shorting the market too. Maybe I already am. I don't know. You'd have to join the courses on building your wealth, link down below, to know what the heck I'm doing. But that's the beauty about joining those. You get lifetime access to all my flip-flops. So if I have crazy flip-flops in the future, you get to be a part of them. You also get to be a part of all the deals that we'll be analyzing for House Hack. That'll be really fun. We get to be a part of a whole lot of things. So check out those programs linked down below with the coupon expiring December 27th. It's the holidays coupon. See? I got my holiday sweater on. What do you think? Can anybody tell me what game this is from? It's certainly not from a game that has short sellers. Okay, so why is the market actually selling off today? Well, we got the GDP numbers for Q3 for the third damn time. I kid you not. We just got the GDP numbers for GDP for Q3 for the third damn time. Okay, this is the third and final revision of GDP for July, August, September. So, July, August, and September, we still had companies that were not really worried about consumer demand. In fact, they were worried about inventory, but they were optimistic about the holiday season, right? Q4. In most company earnings that I read, it was not until October and November, maybe late September in some cases, that they actually started seeing consumers spending less, and they started to see the implications of a recessionary market. It wasn't until October or the end of September at the earliest. But wait a minute. Q3 GDP represents July, August, September. So of course you're not going to get the worst of the numbers yet. Why does that matter? Well, it matters because people are freaking out that the numbers are a little hot and have been revised up once again. Now the revision up is a little bit of a bummer, but again, we're looking at the rearview mirror. Consider the following. The final read for Q3 GDP came in at 3.24% annualized. So they just took the quarterly read, multiplied it by 4. This was above the 2.93% read we had about a month ago, and above the 2.57 read we had at the end of October. So it just continues to get revised up. Now it's over now. The Q3 is finalized, and we're in Q4, so we'll get our preliminary Q4 reads in January, right? We're clearly out of that technical recession, right? Now, the update from that second estimate also had a change from or for consumer spending. They showed that consumer spending moved up from the previous estimate of 1.7% to actually 2.3%, which is also higher than the 2% spend we had in Q2. So in other words, up from Q2 and again revised up. In fact, if you look at this graphically right here, you can see the bulk of the third estimate, which is in orange, and the change in the third estimate really sits on the right side. Financial services, insurance, a little bit for food services and accommodations increase, other services on the far right, and then of course a little there on the healthcare side you've got a little bit of a nudge up. Transportation services roughly flat. Housing and utilities actually down. But when you just look at this from a services point of view, it's really services that are popping off. Now, why is that so scary? Well, services are so scary to the Federal Reserve because the Federal Reserve continues to tell us the reason they have to be more aggressive and hike more and more and keep going and keep going and keep going is because they're worried about part 3 of inflation. Remember, folks, part 1 is goods inflation. That's going down. Part 2 is what we have known as housing inflation, which we already see as going down. Part 3 is services inflation, specifically what that does to wage inflation. And that kind of mixed, hasn't really shown indicators that it's going down yet. And so this GDP report is freaking markets out that, oh my gosh, things are getting worse, not better. But once again, we're looking all the way back to July, August, September, rather than looking forward to what do we think is actually going to happen in Q1, which is unfortunate because this means that once again, the Federal Reserve is looking in the rearview mirror and potentially pushes us into a dirty and dark recession where we end up fighting deflation rather than inflation because the Fed overdoes it. Now we'll see. We're not going to hear from the Fed for another like 5 weeks, 5.5 weeks, which kind of nice. You won't hear from them until February 1st. But what is the market pricing in for a Federal Reserve terminal rate? Well, unfortunately, it's up, right? We used to, this terminal rate back when the last Fed meeting occurred was sitting at 4.9. Then the last Fed meeting occurred, and we got a little bit more of a hawkish powie wowie. And what did it move up to? It moved up to about 4.95. But what did it do over the last few days? It moved all the way up to 5.26. And I really, really hate saying this because it's pissing me off. But remember how I've been telling you that there's one chart that just really needs to go down? One chart that thankfully is starting to fall, and soon enough it'll be lower than those peaks that we saw in 2018, and soon enough it'll be trending down and it'll all be great and the Fed can U-turn. I have bad news. That chart is the 5-year break-even chart, and unfortunately that chart actually over the last 3 days decided to spike again. Yeah, that's not good. And unfortunately, markets are still pricing in this belief that we're going to have a cut in 2023. You can see here this orange line that kind of looks like a hat, how it kind of inflects. Where that inflection is November, December, and that's kind of implying a potential rate cut. So in a weird way, you have the bond market, futures market saying, okay, look, we think inflation's coming down, but it's not plummeting per the break-evens. On top of that, we think the Fed is going to give us a cut, but we've always had to be more hawkish with the Fed than what actual estimates have been, sadly. And the Fed, unfortunately, is just staring in the rearview mirror, looking at Q3 data from a time before in which we actually had companies starting to freak the hell out about consumers and consumer spending like they are in Q4. And you've got the most puts outstanding we have ever seen in a very, very, very long time, I think potentially ever. When that flips, it's going to be glorious. And there's a potential that flip either comes in January when people start rebuying after their tax loss harvesting. Doesn't have to be right away at the beginning of January, sometime in January. It could be after we get inflation data in January. It could be after the Fed meeting in February. Or it could just be after the Fed U-turns. Nobody really knows. But there's got to be a glorious unwind of the shorting that's happening. And I think it's going to be glorious. So buckle up.